Hello traders, and welcome to my video where we are going to compare the RSI indicator with the Stochastic Oscillator. So these are two of the most popular indicators used for trading. They can both be used in trending and ranging markets. I'm just going to look at two examples in both trending and ranging markets so we can gauge which indicator would be best for each scenario. So first of all, let's start with a trending market. There you can see we have a clear downtrend. Here I've placed both indicators on the chart. You have the RSI, Relative Strength Index indicator there using the default settings with a 14 period, 30 level and 70 level. Basically with the RSI, anything below the 30 is considered oversold. Anything above the 70 is considered overbought. Okay, we're also going to look for divergence on the RSI, which is lower highs. So here you can see this high here, and here is lower than this one, suggesting a downtrend. And okay, let's have a look for an uptrend example for you, just to reiterate. Here you can see upwards divergence suggesting an uptrend. As you can see, the market is moving up nicely there. Okay, so that's the RSI indicator. Traders will tend to look to sell when the price is in and around this overbought area of 70, and traders will look to buy when the price is in or around the oversold area of 30. Okay, now moving on to the stochastic oscillator. This is basically a technical indicator used to determine the direction of the trend and the strength of the trend again. One of the main advantages it has over the RSI is it just gives a better visual representation of the direction of the trend. Whereas the RSI could perhaps be considered better at showing the momentum. Nonetheless, the stochastic is a fabulous indicator that is used by many traders. So we're looking for basically when the main line is above, let me just zoom in. When the main line is above the signal line, it suggests an uptrend. Okay? And when the main line is below the signal line, it suggests a downtrend. Now the key thing with the stochastics is the 20 level here and the 80 level here. So basically anytime the stochastic is in or around the 20 level, price is considered to be oversold and we're going to look to buy. Vice versa, if price is in or around the 80 level, price is considered overbought and we're going to look to sell. So the ideal scenario with the stochastics is a crossover in the direction you're looking to trade in the oversold or overbought area. For example, if we wanted to trade this downtrend here, we would look at the stochastics. We'd look for a crossover in or around the extreme area such as there, and we'd be looking to place a trade coming from this pullback somewhere here. We wouldn't necessarily jump straight in. I would never jump straight in with any indicator. However, we can gauge the price, how price is going to react around here, wait for the pullback, and perhaps use it per level of support and just look to trade the breakout of that trend downwards. Okay, so that's the basic principle behind the stochastic and RSI. Again, with the stochastic, you can also look for divergence as you would in the RSI indicator. You can see divergence to the downside there. Sometimes the indicators will clash. You can see the RSI is actually diverging up there where the stochastic is down. However, things are always open to interpretation because you could say the longer term divergence on the RSI is in a downwards trajectory. This is why it's important to combine indicators, and for me personally to just look at price action. You use your eyes, see what price is doing, have support and resistance levels marked off on your charts, candlestick patterns, so on and so forth. And you can find, and obviously good money management, and you just find that by combining all these different factors, you can create a good solid trading strategy. Okay, so if we're trading this downtrend and we're going to use the RSI, it's not, in my opinion, the best tool for entering trades. I mean, there are many traders who will say just sell when it goes above the overbought level. Well, you can see it didn't on this downtrend. Bearing in mind this is a 1 hour chart as well, so that was over a week's worth of trading when the RSI didn't signal on a basic, if price is above 70, sell. Okay, what it could have done is it could have helped prevent us from entering a sell trade on this trend in an oversold market. So for example, when the RSI was oversold here, okay, we may have avoided selling, right? So when it came to this peak here, if we tried to sell, it wouldn't have been an ideal price point. You can see there was a pullback. Same here, when price was around here, wouldn't have been an ideal time to sell as the RSI was oversold. We want to look to get in before, before it's oversold. So the RSI is good at filtering entries, in my opinion, rather than being used as a tool to just sell above the overbought and buy below the oversold. I mean, and this is a good example here. If you just buy every time the RSI falls below into the oversold zone, well, that's a terrible trade. And the same around here, you're not going to buy once it just goes into the oversold zone. That's why we need to identify the trend first and look to trade in the direction of the trend. Okay, so I use the stochastic, I think, is just better for filtering. We've drawn our trend line. We've got the bearish divergence, so we can say thanks to the RSI for just confirming what we sort of already knew from just drawing a basic trend line ourselves. However, it does help us to gauge the momentum of said trend. Moving on to the stochastics. Now, this is perhaps better at immediate price action, in my opinion. It tends to react quicker. I just find it, whereas the RSI is good at the overall picture, the stochastic tends to tell you what is happening within that overall picture. Okay, so for example, whilst there is divergence on the downside here on the RSI, you can see there's instances where the stochastic is crossing in an upwards direction. So that can again keep us out of potentially dangerous, risky trades. It's not always going to be the case, but as a guide, the stochastic can be a good confirmation tool. It can be good to time your entry into trends if you're confident that you want to get in on this trend. The RSI is not already oversold, so we're going to look for stochastic crossovers in and or around the overbought area. And I say, okay, so we wait for price to break away from this resistance area, which has formed a triple top pattern and also a wedge. So we have a breakout around here. We can be confident that we're going to start a downtrend. The RSI, as I said, is showing divergence, bearish divergence, and once we've broken through this level, we can wait for a pullback. We have a nice pullback here to this trend line. And the stochastics can be used for timing entry. As you can see there, it's near the overbought zone. It's crossing over to the downside. It's actually a good entry point into this trend, which would have been around 350 pips and counting. So as you can see, that's an example of the stochastic being good for entry, and it can be good to prevent you from taking a trade. If you were thinking to sell here, you might look at the stochastic indicator and say, okay, it's clearly oversold, it's crossing in an upwards direction, it's showing bullish divergence, the RSI is oversold, I'm going to avoid trading here. Okay, so you're not selling at the low there. Wait for the pullback. Okay, again, bearish divergence and a crossover above the 50 level. Okay, we're slightly away from the 80 zone here, but it's still a valid entry when you consider the divergence on the stochastic, divergence on the RSI, and most importantly, in my opinion, the price action here. Okay, you can see this support level forming almost a diamond formation. This support is breached, then becomes resistance. It would have been a possible entry around here. Again, coincides with a crossover to the downside of the stochastic indicator. Plenty of bearish candlestick patterns. I've done lots of videos on candlestick patterns you can watch just to understand how to interpret them. And perhaps the key level here would be the level of support there. See, 1, 2. It's tested twice, and then when there is a breakout, it's quite a substantial breakout. This has actually formed a wedge pattern as well, so that would have been good confirmation for this particular trade. Again, if you're here and you're thinking to, wow, I'm gonna buy, I'm missing out on this, I've missed out on the downtrend, let me jump in here. I mean, you don't really need indicators to tell you that would be a bad idea, but if you wanted to, the RSI will help filter it to avoid you doing so, because it's already telling you it's oversold, as is the stochastics, which has the added benefit of being crossing up to the upside. So if you were counter trend trading, the stochastic could have been used for an entry point there. As I said, you wouldn't really want to take the RSI signals as buying and selling every time it goes above or below the 70 and the 30 level. Okay, so just to reiterate, the RSI is good at filtering the if the market is overbought or oversold to avoid trading, whereas the stochastic can be used to actually time the entry. You can use as well the stochastic for looking to exit positions. However, you will find that this will take you out prematurely more often than not. Okay, so what I would do instead is just use support and resistance levels once price drops down to here. Say you entered on this breakout here. Okay, wait for price to fall, have a pullback, fall again, and then you can just move the stop loss above the recent high and lock in as much of the trade as possible. With a trailing stop, you can of course close part of the position on the way down, but as you start to see this bullish divergence on the RSI, you may be considering this move is coming to an end. We then go into a ranging market. So hopefully that's made it clear how you can use the RSI and the stochastic together. I mean, this is a versus video, but they can complement each other well. If we're just saying which indicator is the better, I'll probably say the RSI for avoiding trades in oversold or overbought markets, whereas the stochastic I feel is better for determining the direction of the trend and timing entries. Yeah, so that's in trending markets. Okay, so now we're going to look at ranging markets. We'll just follow on from this downtrend that we were trading just now and mark off this range that we have established here. This is, as I said, a 1 hour chart. It's a pound-dollar chart. You can use the RSI and stochastic on any trading instrument and chart time frame. I'm just focused on the 1 hour because I find the signals tend to be more reliable due to the fact that there's more price data implemented. Same for the 4 hour and the daily, weekly and monthly if you're more of a long-term trader. You can, of course, go down to the 5 minute and 5 minute, whereas this range would probably have loads of trends within it if you just want to trade for a few pips here and there. Some may argue that, even on the 1 hour here, you can trade that downtrend there, this uptrend here. But I'm gonna, for the purpose of this video, we're going to see this as a ranging market, just so we can emphasize how the RSI versus the stochastic would compare in a ranging market. So for me personally, the RSI I wouldn't really use if I'm trading in ranges. I just feel like you can see here that was a sell opportunity, right? If you wanted to trade the range, and that was a buy opportunity. I mean, the RSI, it wasn't overbought and it wasn't oversold at any of those points. Granted, it did come near to the oversold level here, however it didn't cross. So if you were just using that solely as a signal for entering in a overbought or oversold market drawing a range, you know you would have been missing out on your trades. It can help identify a range. I mean, you can just draw lines on the chart to see that, but if you see that it's not really making higher highs, the levels are quite similar, same for the lows. You know, it's just telling you what you can see by looking at the chart. We're in a range. So the RSI, really, for the purpose of range trading, I personally wouldn't be using it. Some may argue you can lower the periods and get it to react faster, which you can. As you can see, if we change it to a 7 period there, it will do a better job of picking out the oversold and overbought market conditions. And yeah, if you're trading ranging markets, that is an option, but I always prefer to use the default settings. Okay. You can, you know, use the RSI to trade from support and resistance in a range. If you just want to look at it, okay, and say this level here, let's just say this support level has been touched there, even further back to here and here. So this is like a strong support level. So when price did come and fall around this area, you know, you could have said, well, the RSI perhaps is suggesting a buy trend within the range. However, the point I'm trying to make is you can just look at your chart and that information is there. You don't need this indicator necessarily for trading in ranges. Okay. The stochastic, on the other hand, I do find to be useful for range trading. As I said, it tends to do a good job of identifying the trend direction, and this is both in the short, mid, and long term. So stochastic can be handy for picking tops and bottoms in a range, just as it is in picking pullbacks on a trend, what we were looking at previously. Okay, so if we just say we've established our trend here, our range. Even the initial range would have been probably up here somewhere. And when price came to this area, we see the stochastic cross downwards up near the overbought area. We could have been considering a sell trade here, which you can see would have been a good trade. On the contrary, there was a cross over to the upside here, which some may argue, you know, would have been a position to take if you just blindly trading the stochastics on crossovers. However, we had just come off the back of this long trend here. We still had the RSI again doing a good job of filtering with the bearish divergence. Okay, I hadn't quite established this level of resistance and support yet, which is why I emphasize they're good. The indicators are good when combined together. Okay, and we did have arguably here crossover near the overbought area, some pips in that move there. Here we're perhaps too near the support level, and then we did have a breakout which to the downside, a small one, so we'd be waiting for the stochastic to come up near this area here. Potential trade there for some pips, but again, we're sort of in the middle of this zone here. That being said, we can always hone into the nearer range and start picking off tops with the stochastics. See there, you know, short trade there, 10-20 pips. And there, not a fantastic trade, but this is why the RSI would do a good job of avoiding, because you have the bullish divergence to the upside there. Okay. As I said, this is the anything 20 or below or around that area is considered oversold on the stochastic. So you can also trade long positions. For example, there, that crossover, this crossover, long, this crossover, buy trade up, and this one. A nice crossover again, RSI with some bullish divergence, and we arguably have a breakout of this divergence here, which, you know, you can just mark yourself on the chart. So it's a good breakout going on there, but this resistance level has held up nicely and price is pulling back. Interesting to see how that move plays out. You might be considering a short position if you're dedicated to stochastic crossover trading. The thing about this range is we saw there's a few trades, 10 pips here, 20 pips there. I mean, I'm not too sure why you do that when you can zoom out and you can catch moves for over 300 pips. I mean, you know, each to their own, but I'd much prefer to just catch the big trend, because even if you're wrong, I don't know, say you have a 10 pip stop loss and you're wrong 5 times, okay, you're down 50 pips, but then you get a winning trade for 300 odd pips. I mean, 350 plus pips, you're going to be 300 pips up. So yeah, trade as you please. You know, these trends don't happen often, but with so many trading instruments, whether that's Forex, currency pairs, majors, minors, exotics, or commodities, stocks, cryptos, indices, wherever you're poisoned, these opportunities are always going to be around. Consider what's one trend on there might be trends on other time frames that you're not seeing as well. You can use it for day trading, swing trading, scalping, if you please. But yeah, in a nutshell, the RSI versus the stochastics, I'd say, in my opinion, the RSI is probably better for overbought and oversold analysis to avoid trading in such markets, and whereas the stochastic I prefer for timing entry. In terms of money management, I wouldn't probably use either for exiting positions. I'd be looking more at the price action and what's happening now, because as we know, indicators can be lagging from time to time. Okay. Hopefully you found something useful in this video. I appreciate you watching. If you could please like and subscribe, that would be fantastic. Hope to catch you on the next one.